Let's talk more about the big reports, and most notably, of course, the big jobs report that we are expecting. Aneta Markowska is with us now, Jefferies Chief Financial Economist. And Aneta, it was so interesting reading through your preview of the jobs report, because you talked about some sort of underlying off the beaten path economic indicators that you're looking for jobs. Sounds like you're a little bit more pessimistic on jobs growth for the month of May, but at the same time, you acknowledge the difficulty in predicting, right? Which we saw very much on display last month. So talk to us about your process in the wake of what happened.
Yeah, it's definitely hard to have a lot of confidence in any forecast given last month's miss. And, we assume this was all about labor shortages, but of course we don't know that for a fact. And real-time indicators of employment have been somewhat confusing, right? Because if you look at labor demand, whether it's job openings, initial claims, consumer confidence survey, all of those demand side indicators suggest that we should be seeing job growth on the order of 1 million or more. Open table bookings, for example, are consistent with 1.2 million jobs created in leisure and hospitality alone. So that's what we're seeing on the demand side. Unfortunately, we don't have too many real-time indicators that actually provide hard counts of employment or unemployment, but the ones that we do have, whether it's home-based chronos or even continuing claims, really suggest another very, very tepid month for employment. So, there's a lot of conflicting data out there, but we do think, just based on those hard count indicators, that the risks for this month are probably tilted to the downside. I think we need to be prepared for that, and I think we also need to be prepared to dismiss that if it is in fact on the lower side of consensus.
Aneta, states pulling back on that extra pandemic unemployment insurance, is that one of the best things that can happen to the labor market recovery this summer?
I think that's one of the reasons we are likely to see job growth actually start to pick up in June, and certainly as we go into July. As you mentioned, there's 24 states as of now that have announced they're going to be pulling out early, most of them around the second half of June. It's roughly half of all states. They account for about 20-25% of all unemployment. It's about 3.5 million people that essentially will be losing benefits completely, or seeing a substantial decline. So to the extent this has been a headwind on hiring, which I think it has, there's going to be roughly 3.5 million people suddenly becoming very motivated to actually take these job offers. So I do expect things start to improve in June, July. And also vaccination rates are improving. I think that's been a factor as well, and that should start to kind of ease on balance. And lastly, I would say, businesses just can't afford not to hire. So at the end of the day, if you're in a leisure hospitality sector, you've had no revenue growth for 15 months, and now you have the opportunity to actually generate that revenue growth. You're not going to turn down business because you can't hire people. I think businesses are very, very motivated to hire, and at the end of the day, they'll pay whatever they need to pay. We're seeing a lot of anecdotal evidence of that, and I think ultimately this gets resolved through wage gains rather than persistent employment weakness.
And, Aneta, ultimately the market is interested in the economy because of how the market believes the Fed's interest in the economy will evolve over time. How are you expecting the Fed, when there's a lot of Fed speak this week coming up, to kind of change their tune, if at all, based on some of this data that has both come in and is expected to come in the coming weeks?
Yeah, so it's very interesting because, 2 months ago, Powell said that he wants to see 1 million jobs per month, a string of 1 million prints per month, in order to feel comfortable talking about tapering. And yet, we didn't get that in April. March got revised down, and suddenly the Fed has pivoted. Since the FOMC minute, we obviously have had a number of Fed officials come out and acknowledge that they have started talking about tapering. So the Fed has pivoted. I think a lot of Fed officials are sort of looking through this employment weakness and really focusing on measures of labor demand as much better indicators of the health in the labor market. And I think that's right. And I think they're also maybe becoming somewhat more concerned by not only the wage dynamic, but also the way in which it's feeding into inflation expectations. Because that does increase the odds that some of the price pressures we're seeing are transitory. Are non-transitory. And I will also add that on inflation, we are seeing some continued upside risks. For example, used car prices increased pretty significantly again in May. Rent prices are rising at the fastest clip they've had in several years. And the port kind of traffic jam that has been persisting for the past 6 months, it's continuing, and they hope to relieve some of those bottlenecks ahead of the peak shipping season, right, as we go into back to school shopping, and they haven't been able to do so. So imports are declining. Retailers are just not able to restock the shelves. Inventories continue to decline. And so I think that all of this suggests inflation pressures will kind of continue to be skewed on the upside, at least for the next 3 to 6 months. So yeah, I think the Fed is getting increasingly concerned, and maybe why they are pivoting despite these weak employment readings.
Aneta, it's probably a little too early for me still to ask this question, but it's something I'm starting to think about. For years now, rates have been low. The Fed has been trying to stoke inflation, and it hasn't been successful in doing so until the sort of external dynamics of a pandemic created that inflation, or created a ripple effect that created that inflation. Conversely, when the Fed does start to taper and does start to tighten, are we going to see it not able to contain inflation if inflation proves to be persistent? Do we have the Fed at a point where it's somewhat divorced from the inflation effect that it wants, both on the upside and the downside?
Well, I think obviously the Fed wants inflation to average, let's say, at about 2.5% for the last 5 years. So they're not going to lean against that very heavily. I guess what I would say is, when I look at, for example, the rates market, right, break-evens are consistently pricing inflation overshoot on a 5 and a 10-year horizon now. Is that part of the new framework? And I would say no, it's not. The Fed wants an overshoot for 5 years, but they want inflation to get back down to 2% at some point in the next 5 to 10 years. And if that's the case, and if break-evens are correct, then that will require at some point a more aggressive tightening response. And so if break-evens are right, then to me, nominal rates are wrong, because they're pricing a very, very benign tightening path with roughly 2 hikes a year post liftoff. I think that's what the market's going to have to reprice at some point. Right now, everybody's just focused on the taper, but I think once the taper is out of the way and we really start to think long and hard about, what this new inflation environment implies for Fed policy, I think the market will start to price, again, a kind of a quicker tightening path post liftoff, and potentially the Fed overshooting the neutral rate, because at the end of the day, that's the only way to get inflation from, say, 2.5% back to 2%. So again, I think, the taper is probably very much priced in, but what the taper will allow investors to do is to focus on what's next, and what happens post liftoff.
And do you think the U.S. economy will, in fact, overheat over the next few months? And if so, what does that mean to the stock market?
I do think there's a very good chance it will overheat. I expect us to reach a roughly 3% unemployment rate by the end of next year. So it's not going to happen immediately. But when you look at, again, the amount of fiscal policy stimulus and what that's likely to do to GDP, unless we can sustain 5% productivity growth, the only way to hit sort of, 6% type GDP numbers is with employment averaging 500,000 per month for the next 2 years. And that would get unemployment down to the levels that we really haven't seen since the 50s. So I do think we're on track of that. In fact, when you look at job openings today, if every single one of those jobs got filled within the next month, the unemployment rate would be at around 2%. So job demand is tremendous. I think it's just a question of bringing those people to work. And I think, that will push wages higher sooner rather than later. So I think we will overheat. We still have slack in the labor market. So at some point, I would expect, as these temporary labor supply issues resolve themselves, to, wage pressures to temporarily subside. But then I think next year they'll pick back up again. So I would say by middle of next year, we're going to be looking at kind of cyclically driven margin pressure and cyclically driven inflationary pressures, and that's typically when earnings growth peaks and starts to decline, and when we sort of shift into a late cycle dynamic. So we're not there yet, But I think within the next 12 months, we're going to be making that shift from a early mid-cycle economy to a late cycle economy, which tends to be a little bit more challenging for equities.
We'll be waiting for that to happen and looking for those signals. Thanks, Aneta. Aneta Markowska is Jefferies Chief Financial Economist. Good to catch up with you as always.